Hello and welcome. In this lesson we will continue with inheritance tax. In the previous lesson I showed you a little bit of this pro forma as well, but we will continue with this in the next lecture. But for now we will look at some more aspects of inheritance tax. Now, this lecture is only relevant for P6. Now this data which we will study in this lecture, you haven't seen it before in F6. So this is totally new to you. So you haven't seen it before at F6. In the previous lesson, if you remember, I told you that there are some exemptions in inheritance tax, like the one which I told you, which common was when you transfer an asset to your spouse. So if you transfer an asset to your wife, or she transfer to you, then it would be exempt. Now there are some limitations on that. Let's look at the limitations as well. I will just share the screen with you, as you can see on your notes. Here you go, I've shared the screen with you. Now on the screen, as you can see, it says exemptions applying to pet, CLT and death estate. Now gifts between spouses. It says any transfer of value between spouses are exempt provided the transferee is domiciled in the UK at the time of transfer. Say for example, if you transferred to your wife and she is domiciled at the time of transfer, then that would be exempt. If she is non-domiciled, she is not UK domiciled, then unfortunately it won't be exempt, but there is some limit. So up to £325,000 would be exempt. Excuse me. And if exceeds that limit, that would be considered as potentially exempt transfer. All right, that's what it says in the notes as well. You can just read it. So this £325,000, this is not nil rate band. Many students I have seen who confuses this figure with the nil rate band. Unfortunately, this is exactly the same thing. So that's why students confuse themselves. They think that this is nil rate band. Now nil rate band is something else, whereas this exemption of spouses is something else. Now this £325,000 exemption is only relevant where you transferred an asset to your wife and she is not UK domiciled. In that case, if she is not UK domiciled, as she is Doni, now up to £325,000 would be exempt, and if any exceeds that limit, then that would be a potentially exempt transfer. All right. Now this was a gift between spouses. Now there are some other exemptions as well. As you can see below, it says transfer to UK charities. Now if you transfer something to UK charity, that would also be considered as exemption. After that it says gift to a political party is exempt. And a qualifying political party, you cannot just donate to any political party. If you just donate to a qualifying political party, then that would be exempt. But how to determine if a political party is qualifying or not? There is a criteria. And below that, if you can see, you have to fulfill either of that. Not you, but a political party have to fulfill either of that. Now the criteria is that at least 2 members were elected at the House of Commons. Now 2 members must be elected in the House of Commons, or 1 member was elected and the party pooled at least 150 votes. It's not polite, it's pooled. So 1 member was elected, but the votes were £150,000 or more than that. In that case, it would be a qualifying political party. And after that, it says gift for national purposes are exempt. So eligible recipient include museums and galleries. So if you give a gift for national purposes, that would be exempt. Gift to a spouse is exempt. Gift to a political party is exempt, and gift to a charity is exempt as well. So altogether there are 4 exemptions. Which 4 could you please remind me again? Gift to a spouse, gift to a charity, gift to a political party, and gift for national purposes. Right? Now before we move forward, let me also remind you another thing which we have studied in the previous lesson. I told you when making a transfer of the gift for inheritance tax purposes, how can we calculate the value? We have to calculate the value by diminution in value. Now how to calculate it? That whatever I am transferring, we will not take the value of what the donee is receiving, but we will take the value of what I am losing. Now say for example, if I've given you the shares example of shares. So if I hold some shares and I have transferred them shares, then I will have to see what I have lost, not what Donny has gained. So that is the way to calculate the inheritance tax valuation, right? Now there is a new added rule which is called related party value, which says that when you make a transfer for, say for example, of shares. Now normally what we do is when we make a transfer, we take the value of diminution in value. Now how to calculate it? We'll say whatever I have transferred, well, I will have to take the value before transfer, and I will have to deduct the value I have after transfer. Now net amount would be my loss of value, whatever I've lost. That would be my transfer for inheritance tax purposes. Now say for example, if I make a transfer and if I make a transfer and any of the 4 exempt parties which I have just told you, which you can see on your notes as well. Now if any of the 4 parties own some shares, then that would also be included when calculating this diminution in value calculation. Now you won't understand it now. Let me share the screen with you so that you can read it yourself on your screen, then you would understand it better. It says lifetime tax on transferee. We have already seen this one anyway. So just go below that, and after that, let me see. Here you go. It says diminution in value. Now how to calculate the value? As you can see on your screen, total value of an estate of transfer before transfer. Then what I will have to do is after transfer, value of my estate after transfer. Now the net amount is a diminution in value. Now that would be my transfer. Now next one is related property valuation. That is the one which I told you, valuing related property. Now how to do it? It shows you beneath that. It says for inheritance tax purposes, related property must be valued as proportion of value of whole of the related property only if it gives higher value than diminution in value. Now there are 2 ways to calculate the value. First one is diminution in value, which you have just seen. What I have transferred, what was my value before transfer, what was my value, estate of my value after transfer, the net amount would be my valuation. However, the next one says, which is related property valuation or valuing related property. Now this rule says, what does it say? Related property of an individual must be valued including the property of spouse, property given to charity, property given to political party, and property given for charitable purposes. Now these are 4 exempt parties, as you can see. That's why I asked you to remind me previously what were the 4 exemptions, what were the 4 parties to which I can give gift and that would be exempt. First one was spouse, second one was charity, then it was political party, and in the last it was national purposes. Now if any of these 4 you can say people, if any of these 4 people hold some shares or hold some property, then I will have to include the value of all of them in my own value. We will see a question in a while so that you will understand it better. So say for example, if I sell some shares and I held, say for example, 20% in a company, my wife owned 20%. So when calculating the diminution in value, I will have to include the value of my wife as well. So I will have to take value of both of them in order to consider the whole value when making the transfer. So that is the way to do it. But you will understand better when we will do the question, so don't worry. And after that it says when part or whole of the it says part or whole. Please make sure you rectify this mistake. There is a mistake. It says when part or whole of the related property is sold, then the value of transfer for inheritance tax purposes will be higher of value of transfer without related property using diminution in value method, and the second one is value of transfer using related property rules. Learn the method in class lecture, as it says. So we will see the question as I told you. Now the first one is diminution in value, which we have learnt, which we can see on the notes. The second one is value of transfer using related property. And we will see a question of exam. Just a minute, just bear me 1 second as I will share the question with you. Here you go, I've shared the screen with you. As you can see on your screen, it is question number 13, which name is Brad. Now the allowed time is 49 minutes. Now we won't do all of this question, we'll just do part of it so that you can just understand the concept behind a related property. Now what we are learning, what we are learning here is related property rules, how to value the property. First one was diminution in value and the second one is related property. Now we will have to calculate with both ways. Whichever results in higher value, we will have to take that value, right? Now related property value says when I hold some shares and in same company, if any of the exempt parties own some shares as well, then I will have to include value of all of them if any of the exempt parties hold some shares, right? So let's go to the question and start the question. Now this is actually a past exam paper. Now question number 13, I have just used a BPP exam kit, so this question number 13 is from BPP exam kit, right? If you have an exam kit, please make sure you do that after as well. But let's start from inheritance tax planning. It says that Brad's estate is worth approximately £5 million. He has not made any lifetime gifts, and in his will he intends to leave half of his estate to his daughter, Danny, her name is, and the other half to his wife, whose name is Laura. I pointed out that it may be advantageous to make a lifetime gift to Danny. Brad agreed to consider giving Danny 1,500 of his shares in Omnium Limited and has asked for general summary of the inheritance tax advantages of making lifetime gifts to individuals. Now the last sentence of this paragraph, which says inheritance tax advantages of making lifetime gifts to individuals. Now in the previous lesson, if you remember, I have given you a list of benefits of making lifetime transfer. I assume you have learned it. Now that list is, I told you as well that that list is very, very important. It has been examined quite a few times in exams. Now in this question as well, it is asking for advantages of making lifetime gifts. Now whatever you have seen in your notes in the previous lecture, and you can check in your notes as well, you can just copy the thing, you can just copy the data from notes and just write it down as its answer. Now it is just asking about inheritance tax advantages of making lifetime gifts. Alright, now let's go to the requirements. What does it ask for? After that, the question continues. It says Omnium Limited, in which he is transferring some shares, is an unquoted manufacturing company which owns a number of investment properties. Brad was given his shares in the company by his wife on 1st of January 2012. The ownership of the share capital of Omnium Limited is set out below. Now as you can see on your screen, it says Laura, who is Brad's wife, owns 4,500 shares, which is 45% of the company, and Brad himself owns 3,000 shares, which is 30%, and Vic and Christine owns 15% and 10% respectively. Now they are also family friends. And after that it says the current estimated value of the shares. Now if you own up to 25%, your value per share would be £190, and it could go maximum to £300 if you own more than 80%. Now when valuing the shares, if you just consider diminution in value, if you just ignore related property value, as I said, there are two methods. One is diminution in value and other one is related property. Now if you just consider diminution in value, then you will only take Brad's value. Now how many shares Brad owns? Brad owns 3,000 shares. Now what would be his share price? 3,000 shares, which is 30%. It means 26 to 50% share price would be 205. Now this value 205 is share price of Brad if we ignore related property valuation. Right? Now if we do not ignore, if we include related property valuation, now what does related property valuation says? When you own an asset or property or shares, and in the same property or the shares, in the same company, if any of the exempt parties own shares, then that would be included in your total shares. Now look at this parties of the shares. Who own the shares? Is any one of these are related property? If any one of these is related, is there any political party? No, there isn't. Is there any donation to UK charity? No, there isn't. Is there any for national purpose? No, there isn't any. Is there any spouse? Yeah, there is one spouse. As you can see, it says Laura, who is Brad's wife. Now, Brad's wife owns 4,500 shares, which is 45% of the company. So when considering related property, we will have to include her shares as well. So 3,000 shares plus 4,500 shares, which means 75%. Now we will consider Brad's value as 75%. So Brad's value is 75%. What would be his share price? As you can see, it says 75 to 80% is 290. So now, now considering a related property, Brad's value is how much? Brad's value is 290 per share, as you can see on your screen, because he owns 75% shares, including related property. All right. Now, including related property, his value is 290 per shares, and excluding related property, his value was how much? 205%. So we will have to consider both of them. Whichever results in higher diminution in value, we will consider that. All right. Now that's his value per share. Now how many shares he owns before transfer? Now before transfer, he owns 3,000 shares. He himself owns 3,000 shares. So he owns 30%. So we'll take 3,000 shares multiplied by 205 in first case and 290 in the second case. And then we will deduct how much he has transferred. He has transferred 205. Yeah, sorry, he has transferred 1,500 shares, as in the question it says. Let's see. As you can see here, in this paragraph, inheritance tax planning, in the second last line, it says Danny giving Danny 1,500 of his shares in Omnium Limited. So he's giving 1,500 of his shares. All right. So how many shares he is left with? He's left with 1,500 shares anyway. So we'll take value before transfer and value after transfer. So whatever the diminution in value is, we will have to consider in both ways, in normal diminution in value ways and in other one, which is related property ways. So whichever results in higher, we will take that one. All right. So that's it. We will just ignore this question for now as we move out to our notes, which says, which we'll continue reading. After that, it says quoted shares and securities. How to value quoted shares in inheritance tax. The formula to value quoted shares is given to you in the notes. As you can see, inheritance tax valuation is done on the same basis for CGT. For the CGT is taking the lower of. Now lower quoted price plus 1/4 of higher quoted price minus lower quoted price, and B is highest market bargain plus lowest market bargain over 2. Now this is exactly the same formula which you have seen in capital gains tax, except there is small difference. In A it says lower quoted price plus 1/4. Now this 1/4 is for inheritance tax purposes, whereas it is 1/2 for capital gains tax. Alright, so it is 1/4 for inheritance tax and 1/2 for capital gains tax, and apart from that the formula is exactly the same. So you will take lower of these two. As far as unquoted shares and securities are concerned, a value will be given to you in the exam anyway. After that, it says unit trusts. Units in authorized units are authorized unit trusts are valued at the manager's bid price, which will be given to you in the exam, and you will have to take lower of them. All right. After that, it says life assurance policies. Where a person's estate include a life policy which matures on his death, the proceeds payable to his personal reps must be included in the estate for inheritance tax purposes. So you will have to include in the estate. After that, it says, but where a person's estate included a life policy which matures on death of someone else, then open market value must be included in the estate. So if a policy includes which matures on someone else, which means it could be your wife, then we'll take the market value. All right. And after that, it says overseas property. After that, it says overseas property. The basis of valuation is same as for UK property. Overseas debts are deductible, and if the property passes on death, then the cost of administering and realizing overseas property are deducted up to a maximum of 5% of the gross value of the property. So you'll have to take 5% as administration cost of overseas property as well. All right, that's for overseas property, and if the property is in overseas. All right. Now that is end of this lecture, and we will continue our inheritance tax journey in our next lecture, as we will see couple of important reliefs, which are business property relief and agriculture property relief. And we will also see another question as well relevant to these topics. All right, that's it for now, and I will see you in the next lecture. Thank you very much, and goodbye.